What's going on with the jobs data being so strong on the same day that the manufacturing indicator was horrible?
Well, exactly. And let's look at the data. In the fourth quarter, on an unadjusted basis, prior to seasonal adjustment, we had about 750,000 job openings fall in the fourth quarter. It's erratic month to month. On Friday, we would expect another strong employment report. Unfortunately, I think it's the last of the year.
So let me back up. Are you saying that the job market is as strong as the JOLTS report suggests, or no, you think it's losing momentum here?
Labor demand in the year ahead is going to be a lot worse. You could take a look and say, well, mortgage application volumes are steadying. Well, they're down 38% from January a year ago. We have nothing but construction employment gains behind us. When we get into the spring, we're going to have very severe job losses in home construction. We had home inventories contribute the most to GDP last year since 2010. Marketing and sales positions are going to be lost. If the saying is, too little, too late, in the case of the Fed, it's too much, too late. They're going to be tightening in a period when we right now are facing near-term contraction pressures in the economy.
Kathy, it sounds a little bit like what I think you're warning about as well, that you're seeing signs of a slowing consumer. The manufacturing slowdown is obviously more pronounced.
That's right. Real estate obviously is deeply in recession, but you're seeing that now play out in manufacturing and even maybe the service side. We'll get the ISM service report later this week, but that index dipped below 50. That was a real shocker. We thought the service side was holding up much better than that. And consumer 3 of the last 4 months adjusted for inflation has contracted. So I guess it's negative consumer spending momentum going into Q1. Doesn't necessarily mean we get an outright decline in consumer spending, but we could. And really the last kind of bastion of strength is the labor market. I would say when you dig through the JOLTS data, what was interesting, Kelly, is that hiring continues to trend lower. So even though the job openings number increased and openings to unemployment back towards 2%, hiring, which you think about the churn, maybe that's what's happening. Companies are pulling back on the hiring, and that itself could depress the net job creation, especially, maybe not so much this Friday, I agree with Steve, but going forward should be much weaker.
No, and I think we've had the same kind of thing show up in places like Indeed and ZipRecruiter, and so, that hiring is down somewhat. But Kathy, are you basically saying it's just a matter of time until the labor market slows more? And if so, and if the Fed, the Fed has all of this data too, so is this the kind of environment they want to be continuing to hike rates into?
Well, that's a great question. So first off, I do think it's just a matter of time. You can't have the labor market remaining so strong when you have all these other sectors and weakening and the headwinds affecting it. And companies are really preparing for recession and downturn. So that means they're going to pull back on hiring. Matter of time, if corporate profit growth continues to slow, they're actually going to have to lay off workers. In terms of the Fed, I think generally this is what they're aiming for, not necessarily recession or slowdown, but they want to bring down inflation. And that means slowing down the labor market and aggregate demand consumer spending.
Subhadra, do you think the message from markets here is basically that, I'll say rates, let's say 10-year, the peak is in, it's only down from here. Do you think there's any kind of rational case to be made for 350 being the lows of the year and somehow we go higher, or could rates continue to keep falling even as the Fed, if you think they're going to do 3 more, is raising things on the very, very short end of things?
Yeah, I think that rates have already peaked for the cycle. 10-year yields around 4.25%. Late last year was the peak of the cycle. And our expectation is that yields would gradually decline during the course of this year. That said, I was quite surprised how quickly we moved from 420 to around 350, and we've stayed at that level for over the last month or so. I think the trajectory, broadly speaking, for the remainder of the year in 10-year yields is to head lower. And a lot of the Fed hikes and the pressure is going to be felt by the front end of the yield curve. And that's really where I feel like the markets underpricing the risk of hikes as it stands. I do see both Steve and Kathy's point of view. The data is mixed. That said, I think that the Fed is probably going to stay hawkish at this meeting, and the market's not fully appreciating the fact that the Fed is determined to get policy rates to the 5 to 5.25 range by the end of this year. And under those circumstances, I think there's a potential perhaps for more repricing of hikes over the near term, at least in the first half of the year.
One of the reasons, Subhadra, even as everyone's talking about, soft landing and how strong things still are, the yield curves are pretty worrisome. And then when you start to see ISM doing what it's doing, you wonder if they're kind of ahead of the curve like they usually are. I mean, for the Fed to uninvert, they'd have to cut by at least a point here.